today. We saw consumer sentiment falling by 7%. Below that 100 mark, so now more pessimist than optimist at a read of 97.6. Now, the biggest impacts that we saw were on the retail space, the property space, as well as the banks, and that really saw the Australian market falling into the red after quite a positive start in the morning. So the market down by 0.3%, and that follows hot on the heels of Wall Street seeing another record close. We are seeing some brokers becoming a bit more cautious on the Australian market, with Citigroup putting Australian equities as the underweight, saying that valuations on a PE ratio basis are 10% above the 20-year average, and the dividend yield's fallen from 5.1% down to 4.1%. So all in all, a bit of caution on the market, and of course, every time our market seems to go past 4,200, it seems to fall straight back down again. So technically, still watching that barrier between 4,200 to 5,200, to 5,245 points. And once again today we saw a fall after we had reached that 5,200 point level. So technically looking a little bit vulnerable as well.
John, what in particular is seeing this sort of, you don't want to say negativity, but certainly not much positivity?
Well, I guess when we think about the exciting parts of the Australian market, which has spurred on growth over the last decade, it has been that mining space, and a bit of shakiness in that area I think is really shaking investors' confidence on the market. So while we have seen areas of the market like the defence sectors holding up fairly well, there's now talk that there's huge overvaluations in that banking space, as well as some of those high yielding areas. And then coupled together with that, we are still seeing quite significant weakness in the commodity space, and of course the mining services space continuing to come out with profit warnings. So putting it all together, the Australian market's looking pretty strong around that 5,200 point level, but unfortunately if we have a look at the different sectors of the market, I guess investors probably a little bit stuck for ideas at this point in time.
Where do you see, I suppose, the potential sectors, if you like, in the next few weeks? It seems everyone's running away from mining services. I mean, do you expect that? I mean, do you think it's overdone? We're hearing from Michael McCarthy earlier today. He suspects maybe with a few of the stocks it's a bit overdone.
Well, the market does tend to have an overreaction in the short term. However, looking at that mining services space, I guess the question is what's the catalyst to turn it around? And we're not probably going to see a huge increase in terms of mining capex. If anything, I guess the market's probably going to digest the specific parts of the mining services area which are most prone to a capex downturn, and the areas which perhaps may see an uplift from the big LNG type of projects that we do see here in Australia. Cardno's a case in point. Now, it didn't have a full year forecast, but today it came out with an update, now forecasting profit between $73 to $77 million, and the stock only down by 0.6%, and I think it really reassured the market hearing from Cardno, and that's because only 10% of its revenue is tied to Australian mining. So really it's a small part of its revenues which are tied to the mining slowdown that we are seeing and the profit warnings that we have seen coming out of Australia. And Cardno, because of all the acquisitions it's made offshore, it's more tied to the US story, and the US story is looking much better. So if we have a look at private infrastructure spending, we're seeing gradual improvement there. The public infrastructure spending is still a little bit flat in the US, as well as defence spend, but the fact that it's not hugely exposed to the Australian miners was a positive there, I think, and just a decline of 0.6% there. So I think the market will start to shuffle through where the overreaction has been and which mining services companies may have overreacted to the profit warnings that we're seeing, and that's probably those that look at that oil and gas space and expose more to those big LNG projects.
What camp, Julia, is, in your opinion, bought long here? Is justified some of the falls, man, reaching an all-time low today, or is it a little bit overdone? Your thoughts on the outlook for this stock?
I guess it's difficult because over the last 5 years we've seen massive expansion in capital expenditure, and what a lot of these mining service companies have done is also expanded their capacity. So they've increased their fixed costs and their ability to be able to grow in this area. But what we're probably seeing is contraction at the moment. So I wouldn't be jumping into mining services as yet. I prefer to see stabilization. It's like uranium. Once we saw the Fukushima fallout, a lot of people were saying uranium's a great buy. The fundamentals are looking good, and still we haven't seen uranium prices really recovering. So I think it's probably prudent just to wait a while to see how this story pans out before jumping in. But certainly the market does tend to have an overreaction, but I can't really see what the catalyst is going to be in this mining services area to stem the tide and see a big move back up in this area, because we know that the miners really are coming under pressure. I guess a catalyst would be if we started to see Chinese growth numbers start to improve, but that doesn't seem to be on the near-term horizon.